Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the May investment edition of the Wealthy Behavior Podcast, where I talk to Heritage Financial's Chief Investment Officer, Bob Weisse, about what's going on in the market and investment universe you need to know right now. Bob, what is going on in the investment universe that people need to know right now?
Well, there's a lot going on. I would say maybe things have gotten a little bit better since we last spoke and since we recorded the early April podcast, certainly. Although I guess that was right before the markets went down. So it's been a bit of a roller coaster, but we've recovered nicely. And maybe some lessons learned to discuss out of the little mini roller coaster we've had.
So I
Can we
mentioned
talk
to a
about it?
client the other day, if you went away right before Liberation Day on a cruise and you didn't have Wi-Fi and you came back yesterday, you'd have said to your kids when they picked you up at the airport, "So not much is going on, huh?" I looked at the portfolios but in the interim, it's been, I would say, nutty, to use a technical term.
Yeah, to quantify your year-to-date return, MSCI ACWI is up 1.14%. So the
That's
global
global
stock
stocks.
market, which it's about two-thirds,
Yep.
65% or so US, it's up 1%, and the bond market is up 2.24%. So not getting rich off these numbers, but both global stocks and US bonds are up a little bit. If you dissect it, looking at regions, the US market as a whole, like the MSCI USA is down 3.7%, so a slight decline. But the 1 month return for the MSCI USA is up 11.5%. So that tells you a little bit about what it looked like a month ago. If we're only down about four now,
Yep.
coming off a plus 11.5. Looking at overseas markets, MSCI World ex US is up 12.5% year to date. So very strong performance overseas, and developed international and emerging markets are up about 6.8%.
Yeah. So, Bob, you did a really good job in our last podcast episode. And if people didn't listen to it, I would recommend that they zip through it, laying out April, the tariff stuff, what's going on, what could be going on. And so I don't want to dig into that yet again, but something did kind of materialize in the last few days related to GDP and the possibility of a recession, and maybe some questions that we're getting around that related to investing around a recession that I thought we could dig into a little bit. And as a starting point, first quarter GDP contracted a little bit, contracted by 0.3%. And now the definition of a recession, a lot of people think is basically 2 quarters of negative GDP growth. But that's not the definition. The definition is somewhat vague. It's the National Bureau of Economic Research, and they're the ones who kind of call and timestamp these recessions. And on their website, a recession involves a significant decline in economic activity that is spread across the economy and lasts more than a few months. Nevertheless, not to split hairs, I mean, if you have 1 quarter of negative growth, you get another quarter of negative growth, you're at least in the ballpark of thinking of whether, we're in the midst of a recession.
Yes, it's kind of funny. A lot of people say 2 quarters of negative GDP is a recession, and it's like, well, no, not technically. It's what you said. But then when you think of what you said, you said longer than a few months, so it's basically 2 quarters of negative GDP. And if you've got one on the books already, then we're one print away from a not technical, but probably more likely than not recession. And that's with the big caveat of if there's a second negative quarter, which by early indications, it's not looking like there will be.
Right.
Like if you look
Yep.
at, we've talked about the Atlanta Fed GDP now as an indication, as a leading indicator of what you're going to get, for Q2 GDP right now, it is positive. So, but it could go that way. So there's definitely, I would say, a heightened chance if it's like, flipping a coin and you got heads the first time, we know that, then the chance of, getting two heads in a row is higher. So there's an increased possibility of a recession. And as far as investing, like, so some people would then say, well, if we might be going into recession, should I not invest or should I go to cash? And it's not that simple. Something to think about with markets is markets are forward looking. They're always trying to look around the corner, so to speak. So markets are collectively thinking there might be a recession. So how should we position? And then fall as recessions or slowdowns in the economy, you have troughs where they bottom out and then recoveries. And the rule of thumb is the stock market bottoms like 3 to 6 months before the economy bottoms. So even if if we were to hit a 2 quarter recession, so a mild recession, you'd be looking at a bottom sometime around last month.
Yeah, and Lizanne Saunders, I think, had a great article about this. She's Charles Schwab's chief investment strategist. And what I took out of it is that stocks basically start recovering during the recession, not after it, which is another way of saying what you just said, basically, in that recessions aren't always forecast by stock market weakness. Some recessions were predated by weak markets, some were not. But if your thing is, well, I can see a recession around the corner, shouldn't I kind of outsmart what's going on and wait till it's over to invest? You've kind of missed the turn because the market turns before the economy bottoms out.
Exactly.
Yeah. So, I mean, in your look at Q1 GDP, what drove the contraction, and how concerned are you about that, regardless of whether people use it as a timing mechanism with their portfolios? How concerned are you about the economy right now?
Not terribly concerned, but part of what fed into the Q1 GDP number was trade, and you can't avoid getting back into politics here. And with the announcements of tariffs, what it looked like companies did was they tried to front run tariffs, which makes perfect sense. Like if you're a manufacturing company and steel is a input part, and so you're an automaker, say, and you need steel, and you're expecting tariffs on steel, so the price will be going up in the future. What do? Well, you buy a couple extra quarters worth of steel today. And so we saw a spike in imports. And when last podcast, when I talked about C plus I plus G plus net X, NX equals GDP, when you have a trade deficit or an increase in it, meaning more imports than exports, it hits GDP. So you could look at that as more of a technical item as opposed to a fundamental issue, meaning not something fundamentally wrong with the economy, but rather just businesses are actually being intelligent and trying to front run a policy change. And but if that policy never materializes, then there's not really an issue to worry about. So there are some little signs of economic weakness, but a lot of it does lie with the tariffs and policy uncertainty. Like there have been companies recently not producing earnings guidance for the remainder of the year, citing just uncertainty and not knowing what the rules of the game are. So that's a little concerning. And it's more things like that that I think are bothering investors today, as opposed to concrete numbers like jobless claims going up, as an example.
So you're not too concerned about it, but the uncertainty overhangs still, right? And
Yes.
we're seeing more volatility. So do you think, in essence, that the market had a kind of worst case scenario reaction in early April, and now they're pricing in something a little bit better than the worst case, even though they may have different views as to where this ends up shaking out?
It's gotten better with the poster board tariffs, the ones that got up to, I don't know, 98% or so, the reciprocal tariffs. Those I think are off the table. That deals will be made with just about all those countries, and I think that's what market's expecting. And then you're dealing with the 10% tariff, but there's still a lot of unknowns. So it's the size of the unknowns has gone down, but it's still significant. I mean, I've heard the analogy of like flipping the game board over. My kids are 8 and 11, and you're an hour into a game of Monopoly, and everyone's got the houses and hotels built, and then someone throws a temper tantrum, maybe it's dad, and flips the game board. You can't just put everything back as it was. So
Are
it's
you talking about yourself, Bob? Did you actually do that?
no, I'm joking.
Okay.
Uh, I wouldn't do that. My kids might. But you can't, I think there has been some damage done to the US and the global trade system, and how we navigate through this, you don't know. So it's uncertainty. That's how I'd put it.
Okay. And when you look at the bond market, I think there was some volatility in yields, but has that stabilized or has the
It
yield?
has.
Okay,
Yeah, so something I thought would be interesting to talk about on this podcast at some point, maybe we'll do it now, is the difference between fundamentals and technicals. So
sure.
fundamentals are like if you think of a company, a stock, like the earnings, the dividend, the sales, the financials of the business, basically, or a bond, like a U.S. Treasury bond, it should trade based on where the short-term rate is, where inflation expectations are. So, financial and economic inputs. And that typically drives prices both short term and long term. So I would call that fundamental driven investing or fundamental movements in price. But sometimes there's what professionals call technicals that move prices. And an example is when market prices move based on supply and demand. So, for example, with municipal bonds, so municipal bonds are tax exempt bonds. The beginning of April is typically a weak period for municipal bonds. And you scratch your head and say, like, what is it with the beginning of April? Well, who owns municipal bonds? People who pay taxes. And what are people in early April doing? Paying taxes. So what are they frequently doing? Selling their municipal bonds. So it's a seasonally weak point for municipal bonds. And I think in also in early April this year, right after April 2nd, so then it goes around like April 5th, 6th, 7th, we saw treasury yields spike and treasury yields were going up while stock prices were going down, which was unusual. And I think that was also technicals, and that there were a lot of sellers of treasuries, not for fundamental reasons, but for more tariff, political type reasons that foreigners maybe just didn't want to own treasuries or hedge funds were unwinding, as opposed to, you know, finance professionals using inflation inputs and in some formula to value treasuries. But then fundamentals, the point is eventually fundamentals come into play and kind of win in the end. So you had a technical driven sell-off, while there was just more people hitting the sell button than the buy button. But then the market kind of weighed out what treasuries should yield, and it got there. So the yield spiked, but then they kind of came back down to earth, and that's where we are today.
So your view of the bond market is we have a little bit of duration in our portfolio. We're close to the benchmark,
Yeah.
and you feel like that's the place to be. You don't want to be on the longer end or the shorter end of that.
Yeah, our average maturity is around 5.5 years, and I think obviously I think it's a good spot because there's risks on both ends. If you're too short, you have very serious reinvestment risk. So let's take the extreme: you buy T-bills or money market. If the Fed cuts rates, then all of a sudden now you might get 4% in a money market, but that could go down to zero, could go down to 0.12. And if that happens, then you're out of luck because your money markets yielded zero not too long ago. Now your money market's yielding zero. And you go to the bond market and the whole yield curve could shift down and 4% could be nowhere in sight and you're stuck. On the long end, there's a lot of price sensitivity. So if rates go up, you can see big changes in price. And if inflation expectations go up, you can get hit pretty hard on the long end. So being where we are, we're thinking of it as locking in today's rates in the 4 to 5% range for about 5.5 years, which is a meaningful time period for our investors. But it's not taking excessive price risk if rates go the other way.
How about credit quality in this environment, Bob?
Yeah, credit quality, we're pretty high in credit quality, meaning keeping it investment grade, single A, double A, triple A. We have a sliver that's below that, but mainly investment grade. And one thing I'd point out with that is a lot of bond managers, like if you're watching CNBC and hearing a bond manager talk his or her book, at times they may be talking about junk bonds, meaning below investment grade. But these professionals typically think about their bond fund in a silo. It's as if you put your entire net worth in this bond fund and they're optimizing it for fixed income or they're managing against a benchmark like that. That's how they're thinking. When we own bonds for our clients, most of our clients also own stocks.
Hmm.
And interest rate risk, that is the main risk with investment grade credit, is typically has no or even negative correlation to equity risk. So if the economy is going south and you're headed towards a recession, typically people are selling stocks, stock prices are going down as the economy slows, but people are buying bonds for the quality, and interest rates are falling and bond prices are rising. So interest rate risk is a good hedge. Credit risk, the risk of default, typically increases in a recession. I mean, that's when you don't want credit risk. So why own bonds? To help protect against a weak equity market? High yield doesn't do that for you. Credit risk doesn't do that for you. So while on a standalone basis, it might look like an interesting risk, we try to not take too much of it because we're taking equity risk in client portfolios.
Understood. And something we haven't talked about, I think, in a while, if at all, is small cap stock exposure. I know heading into the year, the team lightened up on small cap exposure. We had some in the portfolio. Now we have less. That's what lightened up means. And curious as to, why we did that. And I do believe that small caps are underperforming large caps in this environment by a fair amount. What would cause you to maybe revisit that and start to view them as attractive or more attractive?
Yeah, there's a lot to that.
A lot
So
there, I know.
we'll start with the small. So small caps. If you think about company size, large, mid, small. If you look historically, say going back the last close to 100 years, small value is the best performing sandbox or style box, and small growth is the worst. So when you look at small caps, the way you phrase the question, you're getting both kind of the best box and the worst box, and it averages out to about average because of that. So we do prefer small value over small growth because when you think about small growth, what is it? It's small companies that trade at a really expensive level. So there are a lot of like lottery ticket looking stocks, like biotech is the textbook example there, where it's a company that's trying to, find the next cure to cancer, and maybe they have 2 to 3 years of cash on the balance sheet to cover their expenses, and then they go bankrupt if they don't, clear FDA clinical trials. So there's a ton of risk there. And investors tend to like to gamble on, it being the next big thing, and it doesn't work out in aggregate compared to other parts of the market. You also see more risk with small cap. On the value side, though, where you have small cap, you have small companies, and if you're doing both the value and profitability screen like we do, you're looking at both a good balance sheet and a good income statement in a small business, small for a public company. And there you see returns that are pretty good. So that is where we get some exposure. But one wrinkle that we think has made the picture a little murkier is the growth of private equity. So if you go back, I think it was around 1980 or so, there were about 5,000 companies traded in the US, public companies. Now we're about 3,500. So the public market by company count has shrunk in the US over the last 45 years or so. And it's been a pretty steady decline. And meanwhile, the number of companies owned by private equity has increased. And also, if you look at the size of companies going public, like IPOs, that's also increased pretty meaningfully. So, to some extent, what's happened is private equity has kind of taken the seat of small caps. And there's some adverse selection, or you could even call it cherry picking, where private equity kind of gets to pick and choose what companies are public and what companies are private. That's what a leveraged buyout is. They can be taking companies out of the public market and bringing them private. And then when they've extracted the value, they IPO it and bring it public. So with this relatively new actor in markets being private equity, and I say relatively new by like the last 20, 30 years, private equity has grown quite a bit. It does make small cap investing a little trickier because they own a lot of small companies, but they're private. So when you invest in public markets, you're not getting exposure to what private equity owns. So that was one other consideration that led us to lightening our exposure to small caps. Um,
No, that's a great overview. That sounds a little bit more, I don't know if this is the right word, thematic versus valuation driven. So, the setup of my question was in essence, we lightened up on it. Could you see yourself, reversing that viewpoint? But it sounds like it wasn't driven by, valuations being too rich and, if they adjust that you would view it as a more attractive asset.
so I gave you the thematic answer, you're right. And then we looked at valuations and we saw really nothing special, especially in small growth. It looked really expensive. So it hasn't done well for 100 years, and it's expensive today, even compared to history. So it's just, there's really nothing to like there. So that's why we basically exited small growth completely. Small value is more average, not a big outlier in either way. So we have exposure there. So I'd call us more neutral there, but just overall, it was more of a thematic plus small growth being expensive change. So yeah, if valuations disproportionately changed, I could see us increasing, but I would say it is. I led with thematic because that was a bigger part of it. We're not itching to dial up small cap exposure, I'd say right now.
All right, great answer. I appreciate that, Bob. So what else is on your mind?
Well, Warren Buffett's stepping down as CEO of Berkshire Hathaway, and I was just paying attention to the annual meeting over the weekend, and I always like to listen to what he has to say. I think he's full of wisdom and arguably one of the best investors ever. So I took two quotes from the transcript that I thought I'd share in here that I think are full of wisdom. Um, First one I'll read, and it relates to a lot of what we've been talking about over the last month. So I'll start here. What has happened in the last 30 to 45 days, 100 days, whatever this period has been, is really nothing. There have been three times since we acquired Berkshire that Berkshire has gone down 50% in a fairly short period of time. Three different times. Nothing was fundamentally wrong with the company at any time. This is not a huge move. If it had gone up 15% instead of down 15%, people would have taken that with remarkable grace. But if it makes a difference to you whether your stocks are down 15% or not, you need to get a somewhat different investment philosophy because the world is not going to adapt to you. You're going to have to adapt to the world. You will see a period in the next 20 years that will be a hair curler compared to anything you've seen before. That just happens periodically. The world makes big mistakes and surprises happen in dramatic ways. The more sophisticated the system gets, the more surprises can come out of left field. So I just thought that was interesting how he was just talking about, end quote, sorry. I thought that was interesting how he was talking about everything that we've kind of been making a bit of a big deal about is absolutely nothing. And how people take 15% increases with grace. Like market volatility is technically, mathematically, it's two-sided, but emotionally, it's one-sided. Which leads me, I'll just share the second quote. It's shorter, and I think it's better too. Um, Over my lifetime, I've had fabulous opportunities sometimes, and they happen because humans are human. I don't get fearful by things that other people are afraid of in a financial way. The idea that if Berkshire went down 50% next week, I would regard that as a fantastic opportunity and it wouldn't bother me in the least. Most people react differently. End quote. I thought that was great. CEO of a company saying if my stock, if Berkshire went down by 50%, wouldn't bother me in the least. And I'd be licking my chops. I'd view it as a fantastic opportunity. And the investment team at Heritage has a little bit of that mentality with market volatility. We look at it and sometimes you're even conflicted, like, oh, if it goes down a little more, we'll be buying. And like the market's on sale. Who doesn't like a good sale? But meanwhile, clients and advisors are saying, how is this at all good? We're losing money. No one's happy. This podcast is called Wealthy Behavior, and to have an investment mentality of letting volatility be your friend so that if you see big sell-offs, it's an opportunity, it's a sale. So I thought that last quote in particular was full of wisdom to really embrace market volatility. When you have the biggest sell-offs, that's when you should be dialing up risk, not running from it, of course. And just it's part of investing, which gets to the first quote. Markets go up, markets go down. And I just thought it was a lot of wisdom there and something worth sharing with our audience here.
And of course, he's protected just based on the immense wealth that he has, right? So when our clients are looking at a multi-million dollar portfolio in retirement, no more assets are coming in, they're protected by their diversification, but these sell-offs do still provide buying opportunities because they have other asset classes in their portfolios that are not just stocks that could be trimmed or sold to take advantage of the sell-off.
Right. And unless you're younger and working for at least 10 plus more years, you typically have bonds in your portfolio. And it's those bonds that we would be looking to sell to buy stocks in a severe sell-off. And that, those drawdown scenarios he's talking about where you're looking for opportunities, we're not calling our clients asking for cash. It's built into their plan for us to be able to make those changes and take advantage of market volatility.
So I've never asked you this, Bob. So I'm going to make it a simpler version of the question. If you had to go to lunch with three other famous investors and they all had to say yes, you didn't have to, win an auction where you bought lunch with them for $1.5 million. Who would you want to go to a long lunch with?
Warren Buffett and Howard Marks are the two that just come to my mind immediately. Jim
And
Simons,
Howard Marks is who?
he's a co-founder of Oak Tree. He writes great memos that come out maybe close to
I know
quarterly
who he is. I think
now.
he's
I know.
awesome. I just wanted you to
Yeah.
explain it to the team. He's a distressed asset manager, right?
Yeah, Oak Tree, their bread and butter is distressed investing, but he has a thread of Buffett in him as a value investor. But he comments on the general market, and I guess a lot of what he does have to do with behavior, sentiment, value. Just like the way he thinks and writes, and I think he's a very bright investor.
And unfortunately for you, I'm gonna nix Jim Simons because he passed away.
Yeah, that's
So you have to replace him with somebody who's still with us.
I always have been intrigued by Bridgewater, so I know he's kind of controversial, but Ray Dalio, I do think he has a lot of good thoughts, not just on investing, but on philosophies on life and philosophies on running a business. So
How
Ray
many
Dalio.
people would have to be at the table before I get invited, Bob? Are we talking like a convention center or just a banquet hall? Like at what point do I make the list?
Oh, well, I think I already can get a lunch with you, Sammy.
So basically never.
It's a privilege of the job.
All right, that's a privilege of the job. All right, so basically, I'm not getting there. All right, well, thank you, Bob. I appreciate that. I've had you on the podcast 3 episodes in a row because I wanted to grab you a couple weeks ago to talk about the tariff announcements that we missed right after we recorded. So thank you for diving in extra, and I look forward to talking to you next month about whatever the investment universe brings our way.
Sounds good. Thanks, Sammy.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakamis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.